This is Danny Bobrow, President of AIM Dental Marketing, welcoming you to this installment of the Practice Perfection Web-Based Education Series. Today's presentation is titled Profitability Through Growth Make Change into Dollars, and will be delivered by Mr. Ken Runkle. All sustained and long-term business profitability comes from business growth, and all business growth comes from business change. In this session, our featured presenter shares how to bring about change, growth, and business profitability. Ken Runkle, America's Profitability Expert, is a much sought-after speaker and consultant for dental professionals throughout America. Ken consistently entertains and motivates audiences toward higher levels of achievement and practice profitability. As the founder and president of Paragon Management Associates, Inc. and the Paragon Program, Ken has consulted with and presented to dental professionals throughout the country on the subjects of personal and practice development. With more than 35 years of consulting experience to over 1,000 dental practices, Ken delivers strategic and common sense solutions upon which to build an efficient and consistently growing practice. And as attendee today, you will learn to define business profitability, growth, and change. You will be able to implement change, growth, and profitability and understand how to monitor and measure change for growth. You are invited and encouraged to submit your questions at any time using the question button on the provided menu. If Ken cannot get to your question during the webcast, he has promised to do so shortly following his presentation. Attendance at today's event entitles you to apply to receive 1.5 hours of PACE-approved continuing education credit. Shortly following Ken's presentation, you will receive information on how to apply to receive your CE. To be eligible, you will need to successfully complete a brief quiz as well as note the following course number, which is RUN 032323. Again, that's RUN 032323. Everyone in attendance will receive a recording and along with a follow-up email. So if you're driving, don't worry about jotting down that code. And with that, it is my distinct pleasure to welcome to the Practice Perfection stage my colleague and friend, Mr. Ken Runkle.
Hey, thanks, Danny. Appreciate that. It was a very nice introduction. And Danny, you and I go back, like I was going to say, between 2 and 3 decades. So I think you were probably 8 years old when you started your first company. And Paragon is, actually next week on April 1st, Paragon turns 37 years old. So,
wow. No fooling.
Yeah, we've been doing this for a while. So my title today is all about profitability through change, profitability through growth, and how to make change happen. So I'm really focusing on profitability. And what I find is that when I get into it, as I start to explain it, a lot of people almost get confused about profitability. So I'm going to spend really the first 10 to 15 minutes talking about profitability and what it is, and most importantly, what it's not. And that's the part that confuses some people because they're like, well, isn't that profit? I'm like, no. When I first started my business some 37 years ago, so actually my background is, I moved to Columbus, Ohio 50 years ago to go to school here. And then I worked for another, starting 40 years ago, and I've been married over 40 years. Starting 40 years ago, I worked for another firm for 2 years. And then I left that firm and I started Paragon. And it was strictly a practice management growth consulting firm for dentists. And one of the things that I was struck by, this is 30 years ago, was that dentists, now you didn't have the S Corp like you do today, which is, well, you just didn't have that form. You tended to have proprietorships and C corporations. But the part I want you to hear is that you had, when you received a P&L, a profit and loss statement, it would list all your expenses. And then at the bottom of that, it would say, here was your profit. And I kind of, like everybody else, that was just 35 years ago, I kind of went along with that for about 2, 3, 4 years, and then I had a client go through a significant disability problem. What I quickly found is that to bring in another replacement dentist, we needed to bring one in for between 3 and 6 months. It was nonsense to think that this was all profitability for him and his family, because you had to pay that next dentist. And so I started asking questions for the next 10 to 15 years of accountants. Just for the record, I'm not an accountant. I'm not a CPA. That's why I'm able to do this presentation in March, because if I was a CPA, you wouldn't hear from me until April 16th. So I always like to define what profitability is. Profitability is if you take your net revenue base, and then when you take your net revenue base, then what you do is take out all the ordinary, necessary, and reasonable expenses. Now, more on that here in a couple of minutes, but you take out all of the ordinary, necessary, and reasonable expenses, then you would pay yourself what some people call in the EBITDA calculator normalized earnings, which normally means about 30% of your net production. And whatever is left over is the true profitability of the practice. In fact, that's such a big buzzword today that in corporate dentistry, they use this term, which is EBITDA, EBITDA. And EBITDA actually formally stands for earnings before interest, taxes, depreciation, and amortization. Now, having said that, my son-in-law, who's a CPA, and he's a Columbia MBA, and he's a real smart guy, and is a partner in a very large worldwide consulting firm. I asked him one time to explain to me how EBITDA in corporations, and he sent me an article from the Journal of American Accountancy, which gave 32 different ways to figure EBITDA. So I've kind of just said in dentistry, this is the easiest way to do it, and that is you take your collections and then you subtract your overhead, but it's what your true overhead really is, which is the expenses that are necessary, ordinary, and reasonable. And then you would subtract from that in addition. So this is what most accountants don't do. They don't look at your practice management software, which I'll now start to refer to PMS. So they don't look at your PMS and then multiply, but not the whole practice, but your personal production, and then multiply that by 30%. And then you have to subtract that as well, as if you were just another dentist. I like what a good friend of mine who is a CPA, he calls it handpiece money. That's your handpiece money. That's not profit. That's what you earn as a dentist. If you go home at night and your back is tired, your neck is tired, your lower back, upper back, whatever part of you is tired, that's from that 30%. And what you get is, after that, is what's called profit or profitability. Now, a little thing here I have to discuss, because if you don't, you'll just get more and more confused. If you have an S corporation, used to be called a subchapter S, now it's just called an S corp. Some accountants just say you have an S. It just means that instead of having a C corporation and then a personal tax return, you're putting them together. You'll always have what's called salary and distributions. Those are for tax purposes only. They have absolutely nothing to do with practice management. So one of the problems or challenges with a lot of P&Ls is that most people don't understand that your P&L is doing three things for you at any one given time. Number one, your accountant is using it all year long to prepare your tax return at the end of the year. Now, a lot of my friends are dental accountants, so I don't tell dental accountant jokes. I'm not talking smack about them. I'm just simply saying they're preparing your tax return through your P&L. But that's a tax instrument. You, on the other hand, should be using your P&L as a profitability management instrument, which is totally different than a tax instrument. If you're doing one and not doing the other, you're not getting a good clear picture. And number three is, in a sense, you're also looking at your net worth, not net income, your net worth from your dental practice. You have to understand, 37 years ago when I started, if you went in to talk to a financial planner, they would say, whatever we've put in your investments and or your pension, that's your net worth. If you said, well, what about my dental practice? No, we don't even count that. Hey, if you get paid $1 for your practice, well, that's nonsense today. 37 years later, I'm seeing practices, personal one-doctor practices, doing $2 million in collections, and they're selling for 80% of that. That's $1.6 million. Well, gosh, $1.6 million is nothing to sneeze at. So what you need to understand is, now when I go back to the expense part, when I say necessary, ordinary, and reasonable, you have to understand that, and this is not some kind of a dirty secret, and this is not, but once you get past those normalized earnings, on the whole, I'm making a very general statement, your accountant is going to do what she or he can do to go ahead and make sure you pay all of your tax. You should do that. But also at the same time, you are allowed to, by the U.S. Supreme Court, as well as the IRS tax code, you are allowed to construct your affairs in such a way to minimize your tax. Now, don't bother emailing me. You're not allowed to A, not file for taxes, and B, you're not allowed to evade taxes. You do either one of those, you're going to get spanked. What you are allowed to do is do certain things. So the example I use, and I'm not going to tell where they're at, but I was looking at a doctor's P&L one time in about a $2 to $2.5 million practice. He'd asked me to look at his P&L, and I just kind of went, "Whoa, your cleaning costs are a little bit expensive." He goes, "Yes, they are." And then there was a long pause, and he said, "And my mother-in-law does a perfectly good job." So his mother-in-law was in her early to mid-70s, and she had a regular Social Security pension, and then I think she had a small pension. I think she'd been a school teacher or something. And then she had her husband's pension. I think he was military. But now my guy was also paying her, like, I'm making this up, but the way I remember it is like $6,000 a month to clean the office. So she actually lived very, very, very well. It wasn't, enough to live high on the hog, but, and hang on, that's a perfectly legitimate, and she really did clean the office. So this is not like she was a phantom employee or some of these questions you get all the time. So what I'm trying to tell you is A, he was able to help his mother-in-law. B, it was totally deductible. No, nothing hinky here. But I would conclude, or I would, if I were talking with him, one of the things that I would say is that was a form of profitability for him, because if she worked somewhere else, she probably wouldn't have made that much. And if he hired,
and obviously, Ken, if he wants to, obviously one of the, to your point about paying taxes, you also want to stay far enough within the line so you don't raise the suspicions of the IRS. And then, but let's say that you were selected for an audit, would they not take a look at that compensation? And perhaps do they use a benchmark or a measure about what's considered, reasonable compensation for the service, for the given service?
Yes, but I think, in other words,
if he's paying double, yeah.
If he was paying her $200,000 a year to be the cleaning lady in his office, I think that would raise a red flag. Don't ever forget, some of this stuff, Danny, is just truly subjective. So it's kind of is to, is not, and you don't tend to get the screaming matches with IRS agents about something like that. $72,000, I don't think. Hang on a $2.5 million practice. That's right enough that it's not going to wave a flag. $200,000? Oh yeah. If it was a cleaning service and then it turns out just to be her, yeah, that'd be a problem. Yeah.
We were talking about how to say happy Passover in Hebrew. Another term to know is you don't want to be a chazer, which is Yiddish for pig. Is basically I think good advice.
Yeah. So the reason I'm sharing all that is that when you get through that you're going to know what your true profitability is. So the first question that I kind of throw out to people is, do you know what your overhead is? And the second one that I sometimes tease people is I say, do you know what you deserve to make as a dentist? So the example there I would use is, I had a client once who basically had around a $3 million practice, and about $900,000 of it was hygiene, and the other $2.1 million of production was him, which I would be the first one to say. That's a lot of production. Good for you. So a third, which is slightly over 30%, but a third of 2.1 million is 700,000. So if he's making 740,000, if he asked me point blank, am I a profitable dentist? I'd say no, not at all. You're a productive dentist. You make a lot of money because you're very productive. But frankly, you're not that profitable at all. You're just productive. So for the rest of the talk this evening, I'm kind of distinguishing between productivity as well as profitability. And Danny, you know, because you know of my talks, I've been teaching on productivity for years and years and years and years. So I don't have a problem at all speaking about productivity. I mean, I've got hours that I've taught on productivity, but tonight we're talking about profitability. So for me, I'm, and you'll see it here in this graph in about 5 or 10 minutes. I'm distinctly making a definite decision between productivity and profitability. So when I throw this out and sometimes say, you know what you deserve to make as a dentist? And people are like, wow, I think I deserve 400. I'm like, no, you deserve about a 1/3 of the highest you deserve is about 1/3 of your net production. That's what you deserve to make as a dentist. I didn't say that's what you deserve to make as an owner. That's what you deserve to make as a dentist. Oh, and Danny, you and I go back a long time. I laugh and tell people this all the time. You know, you should always be paying your associate what you want to make if you want to retire, if you want to sell your practice, your associate. I mean, there's nothing worse in the universe than injustice or injustice, which simply means, oh, I'm paying my associate 25%, but then when my associate buys the practice from me, I'd like to get paid 40%. I'm like, no, it's not going to work. That never works. It just never works. So if you're paying yourself a third, then you should be paying your associate a third. When I use the term, do you know what you deserve to make as a dentist? I'm talking about, do you know what you deserve to make in terms of handpiece money? And so if you figure that out, which is what's your true overhead, what do you deserve to make as handpiece money, whatever's left over would be your profit. So I'm going to show you here on the slides what I call a model of profitability. And as I put it together, I'm showing you how to get a 50% overhead. So before the night's over, I'm going to show you how to get a 50% overhead. So the first thing you would always set aside is your payroll. Now, if you have what's called an alphabetical P&L, I hardly ever see them anymore. But if you see an alphabetical payroll, that means at the top it starts out with automobile, and then at the bottom it says waste management. This is going to get a little complicated. But on the whole, most dental P&Ls are pretty accurate, and I'll show you this here in a few minutes. But when I say payroll, for me, this is always non-dentist payroll. So you not only have the payroll in there, but then you would also have in there the taxes, but it would be the portion of taxes that are going to the staff. So sometimes when I'm looking at a P&L, I'm like, I'm sorry, doctor, this P&L is meaningless. It's prepared well for tax preparation, but not for profit and loss preparation, because they just have one line item for, and I'll talk to accountants, and they'll say, well, it's too hard it's too complicated. I'm like, it's not complicated. You know, in a few cases, actually very rare, but a few cases, I'm like, go get a different accountant. Just get an accountant who's going to work for you. If you have a pension plan, you need to know what percentage of that pension plan is going to your staff, and you would put that in the payroll. You'd have to figure out FICA, FUTA, SUTA, workers' comp, all of those tax matches, and put those into the payroll. So
maybe a better catch-all would be employee compensation than payroll, because
through all employee compensation. The only reason I'm saying payroll is just less syllables. But when we say this is not any associates, and it's not any passive family members, and it's true. And like the case I was sharing with the mother-in-law who was the cleaning lady, you're going to kind of have to go back, and you're going to have to split that out. And you might say, okay, well, this much would go here, and this much goes here. And the second category today is lab and supplies. And I'm putting down there, just on payroll, I should also tell you this. I'm putting in CE for payroll, and I'm also putting in there like uniforms. If you said you are, yep.
Interesting. Okay.
If you put in,
not
if you have, they're not going in lab supplies. They're going in payroll. Like for instance, if you have staff that get bonuses and commissions, that would definitely go into payroll. All that goes into payroll.
Everything your non-dental team needs to do their job, basically, it sounds like.
That's all going to be your payroll. And I got to tell you, today in America, it's hard to keep it at 25%. We've had significant wage inflation in the last 3 years since the shutdown, and you got to work hard to keep it at 25%. More on that at the end of the talk. Next one is lab and supplies. That's 12%. To keep it at 12%, you're probably going to have to join a GPO. Danny, if you've endorsed somebody, then I'm not going to step on your parade. We have one that we have endorsed. I don't get a referral fee, an endorsement fee. I don't get a kickback. I've even teased them and said, don't give me a bottle of wine. Pass it all on to my clients. And when I've introduced them, they've actually said, okay, this is the way it is. But number one, you got to be shopping with a GPO. You've got to be careful about a GPO. Under lab and supplies, this is the part where I diverge from some of my colleagues. Like, for instance, if you have a CEREC, let's say you got a prime scan. Well, the payment for the prime scan would go under lab and supplies. You know, I was at the Chicago Midwinter a couple of weeks ago, and I went to a 2-hour lecture/demo, a really good one by one of the 3D printing companies. And my client was like, I think I'm going to either buy one or two. I said, okay. I mean, he's a Cleveland guy. We'd met for breakfast. We'd walked the floor. Then we sat in on the demo, and he just, he's got 16 chairs doing maybe 10 million a year, between 8 and 9 million, not 10. He's doing between 8 and 9 million a year. He was like, I think I may just get two of them. Well, my point is the cost of that machine would go under lab and supplies. That's not, now for me, I'm not going to bury that in facility. I'm going to put that into lab and supplies. So the reason I call it 12% is the old days, lab used to be more than supplies. Today, lots of times supplies is more than the lab because the labs are in-house. If you've got a prime scan and you've got your own 3D printer and it's knocking out all your ortho and your bite guards, your occlusal guards, and you're even going ahead and doing your guides for your implants, you've actually effectively moved your lab in-house. So it's going to have to go under 12% lab and supplies.
And again, I think to keep things straight in your mind, sorry to interrupt, is to remember that these P&Ls have two purposes. One is for tax preparation, and two is for practice management, profitability analysis. The supply sounds like a piece of equipment wouldn't appropriately go in there because you can depreciate the equipment, but that's on the tax side. So this is just to keep things, really clean in your mind as to what the purpose is.
Yeah, and every once in a while I'll have somebody say, so you're saying you have two sets of books. Well, metaphorically, and Danny, I always tease you, you're a Chicago guy. Two sets of books traditionally, metaphorically means, a set that's real and a set that's for the IRS. I'm not talking about anything like that. I'm not talking about anything like that. I'm talking about, I want one that might be for a tax management and the other one is for profitability management, which brings me to the third category, which is facility. Facility is 5%. So now here's where it will get a little murky. So, for instance, regular equipment, I'm going to put under facility. So a doctor who says, I've got 8 chairs, I'm going to 12. Yeah, those other 4 chairs and that build-out is going to go under facility. The old utilities, like for me, that's water and sewage, gas, electric, used to be phone. Today, I see it labeled as connectivity because it tends to be one company, and they're handling your Wi-Fi and everything else, like all of your internet. That's all going to go in facility. Every once in a while, I will have somebody move a little bit out of facility into marketing. We're going to see marketing here in a minute. And the only reason I say that is, we still go into our clients' practices. So, every once in a while, after a year or two, we, as you know, Danny, and you'd ask me not to do a commercial. I'm not. But we have long-term relationships with our clients. Sometimes we're like, look, you've got to do something with the hedges. You've got to clean the gutters. And for heaven's sakes, don't you do it. You've got to do this, this, this. You could do that in facility, but hang on. Sometimes I have guys who are like, I'm already at 6% in my facility. I'm like, well, then throw it into your marketing budget. Because you can't have like killer digital marketing strategies, and then when they get there, the building doesn't meet their expectations.
You got to deliver on the promise.
You got to deliver on
marketing
that.
Is. Yeah.
So sometimes to keep that facility at 5%, again, that can be a lot of work. Now, let me just address this. You're talking to me, and I'm in the suburb of Columbus, Ohio. 2 weekends ago, I was in Washington, D.C., Baltimore, and New Jersey and New York to see our clients on the East Coast. Well, let's face it. I mean, I've got several clients that have, they have space in just enormous buildings in Washington, D.C. Well, and sometimes, and it's strictly rent. They're not going to build up any equity, and they've got a bigger facility cost. But that's the cost of doing business. In Ohio, especially in smaller towns, you tend to see dentists own their own. And back to Chicago downtown, you're not going to buy the building. You're not going to buy the Hancock Tower, for heaven's sakes, to have 3,000 square feet there to produce. What I'm trying to tell you is, in small town Ohio, lots of times you're going to own the building. And occasionally, if you're going to be there 40 years, some of that is going to be profitability. So it's in profitability. Like, and the word that's commonly used in dentistry is Taj Mahal. And they'll go like, oh, yeah, I know this guy. He built a Taj Mahal. And I'm like, well, some of that was facility, and some of that was just profitability. And he built this much. I realize some people aren't able to take notes as fast, but I just tell you this. A real good rule of thumb, and I'll tell you who gave it to me. I'm not going to say his name, but it's probably one of the biggest DSO owners that I know, a guy I really, really, really respect. I've known him for over 25 years. He told me this is the way I figure buildings. And that is, if you figure your collection cost times 4%, that's about what you should be paying for rent. And if you take 4% per month times 7 years, that's actually going to show you. His whole point was then lots of times we just buy the building. We're just like, oh no, in this case, I mean, if it's cheap, it's like, well, we'll just go ahead and rent it for the next 7 years. On the other hand, when it's as good or more than the comps, it's like, oh no, it's just easier for us to buy the building. Okay, then the fourth category is general. General is kind of everything that's not listed in the others. It's like legal, accounting, consulting. It's all your insurances, all of your what I call business taxes. General is kind of a catch-all. To keep it at 4%, you have to shop your stuff, number one, and number two, you have to have a bigger practice. For instance, in Ohio, I work with a lot of $2 to $3 million practices. I also work with $1 million practices. The accounting fees for a $3 million practice are just a smidge more than the accounting fees for a $1 million practice. So the answer there is not to go to your accountant and try to beat him or her down on your fees. The principle there is just grow your practice. Just grow your practice so that now you can get those general costs. Like what I'm trying to tell you is your insurances on a $3 million practice are just slightly higher than they are for a $1 million practice. So all of a sudden, your percentages really tend to drop off. So that's 4% for general. And then finally, this is the last one in your overhead, is marketing. If I have a practice that is not growing, and that's 95% of all practices, I tell them they need to set aside a minimum of 4% for marketing. And yes, Danny, I know you're a marketing guy. I've known that for 20 years. But I didn't throw this into this talk. This is the fifth. So if you count those numbers up right there, that's a 50% overhead. That's a 50% overhead. So if I've got so my example here is if I've got a $3 million practice and that doctor wants to grow, I will tell him 4% of 3 million. Even a guy that went to Ohio State can do this math. I'm like, that's $120,000 or $10,000 a month. You should be spending that on that. Now, what I'll tell you that I see with doctors lots of times when they want to coast, that's the first, and I'll frankly say it, the dumbest place where they cut. well, maybe I should just cut my marketing. I'm like, that's the last thing you should cut. You should absolutely not cut your marketing budget. Your marketing budget is the lifeblood of the practice. If you do that little spread that I put together right there, that is a 50% overhead. So when I talk to people and they're like, in fact, the only reason I say that, Danny, is lots of times in lectures that I do to my own client base, and I do 17 of these a quarter, I'll stop right here and I'll just say, so throw a question at me, like, where would you put this? I want to put new bushes around the dumpster. I'm like, yeah, you could either put it in facility or you could put it in marketing. I want to get new guttering put around the building. I'm like, yep, facility or marketing. We probably need to reupholster we either need to get new furniture in the reception area or reupholster it. I'm like, yep, facility or marketing. Every once in a while, we've exceeded those two. So I'm like, well, you got a little smidge there for general. If you want to have a 50%, overhead budget, you have to discipline yourself to live within this. Like the example I use is, we have clients that will call us before they go to the ADA, AGD, the Hinman, the Chicago Midwinter, and they'll be like, can I afford to get a prime scan? And the question is, do you have room on your lab and supplies? When they're like, no, I'm already at 15%. I'm like, I think we need to make the practice grow a little bit more before we're going to make those payments, or you need to see it for what it is. You're carving it out of your profitability, but gosh, maybe it's worth it in terms of growth. It's an investment in you. Now, let me show you these next two numbers. The next one is doctor commission of 25%. The average restorative practice is 25% hygiene and 75% restorative. So if you're getting 1/3 of the 75%, that's 25%. So what I'm calling here doctor commission can be you, or it can be an associate that works for you, or it can be associates who work for you. So now we're at 75%. And let me just say this, when it's you, when I'm using the number 25%, sometimes I'll have doctors go, well, I want to pay my associate that I'm getting ready to hire. She wants to get a 401k, and she wants to get health, and she wants to get a CE budget. I'm like, fine. You just need to know you can probably only afford to pay her 26, 27, or 28% of your net if you want that to come in at 25% of her supply, 25% of the total practice. I'm saying that's a rough rule of thumb. Sometimes, I know you know this, Danny. I don't watch a lot of TV other than sports. So if I'm watching like Monday Night Football, or right now, not as much this weekend, but last weekend, sometimes, you're just watching March Madness and, seeing who's going to be in, who's not. So, and I'll sit down with a calculator and a long, legal pad, and I'm just working through numbers, and I'm writing them down, and I'm trying to figure them out, and these kind of things. That doctor commission can't really be much above 25%. That's 25% of the whole practice, or about 30 to 31, 32, maybe 33% of their net production. And then finally, we've got 25% for profit. Now, a practice with a 25% well, let me just say this. A practice with a 50% overhead, real necessary and ordinary expenses. The only reason I say ordinary is, don't forget, if a doctor says, oh, I want to take an Invisalign, it's a doctor in Cleveland. I'm thinking about taking this Invisalign course. Well, you could take that Invisalign course in February in Buffalo, not recommended. Or you could take that same Invisalign course in Hawaii, very much recommended. My point is, some of that expense right there is going into profit. You said it is? Yeah, because it's not, I keep going back to, it's not necessary, ordinary, and reasonable. You could have just, run up the road 3 hours and gone to Buffalo in February. But most doctors are like, well, I'll go to either Phoenix or I'll go to Hawaii to take that 3-day course. Oh, and I'm talking about they're really in the course. They're really taking notes. They have every intention of implementing everything they've learned. There's no there's no hinky stuff here at all. I'm not being a weirdo. But some of that is actually going to get loaded into profit, especially if you take your office manager, wink, wink, who you also share your house with. So now you're kind of like that's profit. I hope nobody's hearing from me that I'm arguing you shouldn't do that. I'm just saying from a profit and loss P&L practice profitability standpoint, you should call it. So when I talk people through this, then one of the things I just ask them is, where are you high? And what steps will you need to take to get your overhead under control? Because almost always people will take a look at this. Now, if you ask me, why is this so confusing for most dentists? I'm convinced of this, so I'm kind of pushing through on this talk. The reason doctors are confused is because profit and loss statements don't look like the model I just built. So now I'm going to show you the model. The model is actually absolutely upside down from what I just showed you. I'm saying the P&L, forgive me, is upside down. So let me show you what your P&Ls look like. Most modern dental P&Ls look like this. Your payroll's at the top. Then the next category is your lab and supplies is the next. Then the next category is your facility, which should be 5%. And let me just tell you, some of the modern P&Ls actually have these numbers to the side, like recommended at 25%, recommended at 12%, recommended at 5%. So general is there at 4%, and then finally marketing is 4%. And what I'm telling you is if you stop at the end of marketing, I even see this with some practices. It doesn't change the P&L at all. It doesn't change the tax consequences. It doesn't change anything. But they'll actually put like two double lines right there that are kind of like dotted double lines underneath there. So now they're gently saying we're moving out of what's the necessary, reasonable, and ordinary income. Because as you've added all these up, you're like, yeah, I don't want this to go much above 50%. Well, you stop right there and you're like, nope, it's not. And if it is a little bit, it's like 50.7%, not 57, 50.7, or it's 52, or it's 58. Then we go to the last two, which is the next one is doctor commissions, which we've already said should be 25%. 25% of the total practice, and then the profit is 25%. And I don't even think you have to call it profit. You could call it non-taxed expenses. That's what I see it. It's called a lot of times. This has nothing to do with salary and distributions. Nothing to do with salary and distributions. So when you get through this, then I'm going to show you something here, which is if you take this one and the other one and you kind of put them together, what I'll tell you is you're kind of like, oh, you're just taking the one on the right, which was the model, and turning it into the one on the left, which is your P&L. Yep. And if you look at those numbers, they're exact same numbers. So the model on the right is what you were, forgive me, the model, which is the one on the left, is the one you built, the model, but the P&L is the one on the right. So you're looking at the exact same numbers, because I've had people say, well, if I built that model, how will that affect my P&L? I'm like, it's the same thing. It's the same numbers all the way through. So, one of the questions I ask people is, are you reviewing your overhead with your accountant probably 4 times a year? And sometimes you're just like, hey, where could I cut this? Where could I cut this? Where could I cut that? In Ohio, it is now legal to charge a convenience fee for credit card usage. So you're seeing signs in practices where doctors go in, where you go in an office, and a lot of them are giving, Danny, you just need to hear this. A lot of them are giving like a 6 months to 9 months heads up, which is effective the Tuesday after September 1st, Tuesday after Labor Day. We will still allow you the convenience of a credit card. However, we are going to charge a 3% convenience fee to offset credit card usage. You said, do some patients resent that? Some do. But I mean, let's face it, you're seeing this show up in restaurants. You're seeing this show up in other areas where people are if you don't have, I will tell you this, if you don't have a lot of PPO, If you have a lot of PPO participation, you probably got to put through this 3% fee. If you don't have any PPO participation, in America today, that's about 5% of all dental practices. If you don't have any PPO participation, what I would do is probably raise my fees 3% and then just discount them for cash and credit card. Cash and check.
Or ACH. I'm having this conversation with two of our health partners this week. It is very much current and important. And yeah, that's the only thing I see. You know, as with everything else, there's a right way and a wrong way to communicate this. And having a sign and having coached your team on the verbiage to use is very important. And it's also nice to have that option, which is you have a automated clearinghouse enrollment form available that a patient can complete
at all times. So that's the way you're keeping that overhead down. I will tell you, because of dental, not just dental wage inflation, just because of dental inflation, which is probably up 15% since the shutdown. Overall, dental overhead is probably up 15% since the shutdown. So what I would tell you, this is what I would tell you right up front. What I would tell you is, since the shutdown, if you're doing that, doctors are looking every way they can to really watch their expenses. I'm a reader. There's a great book out called Predictably Irrational. It's written by a guy named Dan Ariely, and it's just an amazing book. But one of the things he talks about is, big changes deserve big announcements. So if you knew you were going to do this, you don't say it on March 23rd, effective April 1st. That's when you get all this blowback. But when you're so I'm not always a big sign guy, but if you know it's coming, then get the sign up so that you're teaching. And I agree with you, Dan, and that's what you have done. You, Danny, your team has done a great job of teaching people over the years. Like, here's the verbiage. We're going to do some scripting. We're going to work about it, and then do this. Then the other thing I'd say is, where does your accountant feel you're high? I will just tell you, on the whole, this is going to be a very generic statement. On the whole, it tends to mostly be high in payroll. In the last, if you're a dentist and you're listening to me, you've probably had this happen, which is your hygienist, your assistant, your front desk has come to you and said, "Doctor, I swear to God, I was not looking for a job, but I don't know how they got my name, but they found me and they want to pay me $7 an hour more. And gosh, if you can go ahead and match it, I will." And you're stunned, and you're like, "I didn't even know you're looking." And you realize now, all of a sudden, you're more or less in a negotiating battle. And the answer is, in many cases, most doctors have said, "I will go ahead and meet that." In some cases, the answer is, you've got a doctor who's like, I've got a client like this. I have 4 hygienists, and he called me. I just laughed. I said, "You're probably going to have to match it, but don't forget, you got to match it for the other 3. I had one guy say, "No, I'm going to tell her to keep this a secret." And when I got done laughing, I just simply said, "Well, let's try that again, because that's not going to happen. You can't give one a raise of $8 to $10 and not think it's not going to get out." And let me just tell you this. Pretty soon the assistants say, "I wonder how much the hygienists all got as a raise." Well, how did you know they got a raise? Because they always used to complain in the lunchroom about they all deserved a raise, and now they've all shut up and they're not complaining. So I'm just telling you, this is how this is going. So this takes me to the next 3 or 4 things, which is, what is your net-to-net collection percentage? I find a lot of doctors don't even take that. I still walk into practices and they'll go, "Well, we produced $1.5 million and we collected $1.2 million." And I always kind of like act surprised and go, "Whoa, who stole the money?" They're like, No, it's always off like that." I'm like, "You're missing 300,000?" They're like, No. And then they start to explain. I'm like, "Oh, so you're saying that was your gross production? Well, what's your net production?" "Well, we don't know. We never pay attention to that." And I'm like, "Yeah, that's why you're getting spanked. You should." The 3 numbers that every practice should be able to share are: I gross produced 1.5, I net produced 1.2, and I collected every penny of the 1.2. So the only reason I say net collection is, some people call it adjusted. The reason I say net production Some people call it adjusted production, and some people call it collectible production. I just use the word net production because it's less syllables. That's all that's about. Nobody should read anything else into it.
Well, let me just clarify for my own benefit, if not that of some of the attendees. What's the difference between net production and collections? I thought that's what net meant, that of what you produced, you collected this amount, and that was net.
It should be, Danny, but you'd be surprised. You'll walk into a practice, and they gross produced $1.5 million, they net produced $1.2 million, and then they net collected $1,180,000. So they're $20,000 short.
So after write-offs, they legitimately billed and should have collected 100% of this, but they don't necessarily collect at all.
They routinely don't. One of the best products I've ever seen is called Inside Desk, that literally tracks all of your insurance production, your insurance receivables management. It really is. I think Inside Desk is the ultimate secret weapon in terms of insurance management. Anytime I see, again, this is totally unsolicited. When I see Inside Desk go into a practice, within 3 years, they're collecting 100%. I don't even think it takes 3 years. I think within 1 to 2 years. And what's wild is some of the bigger corporate DSOs don't even bother with this. And I'm like, you guys are nuts because I'm not going to do anything else about it, but I'm just saying you should know that to the penny, which takes me to so you should know what's your net collection percentage. How can you bring it to 100%? And when doctors don't know those things, I'm like, well, I'm not into shaming or blaming, but I'm like, gosh, you got to turn that around. Next one is your adjustment analysis. And there is what's your net to gross adjustment. It was not abnormal 30 years ago for that to be 5 to 6%. Today, you'll see that in the 25 to 30% range. And in my career, 39 years on April 1st, I've seen 2 clients who had over 50% adjustments. Like one guy was literally like 2.1 gross production, 1.1 in adjustments, and $1 million net production, and collected every penny of that, and was suffering, was making a little bit more than his hygienist. And I said, that's all from your adjustments. And he would use words like, we just need to collect more. If we could just get our cash flow. I finally stopped it once in a meeting. I just went, we need to take a break here. And when we went into his office, I said, there's not a collection problem here. This is an adjustment problem. Your adjustments are killing you. You will have to get out of some plans. And he was terrified, quite frankly. And I think that's done by a number of insurance companies on purpose to terrify you. And I just said, it's more terrible to go bankrupt. I mean, my heavens, look how hard you've studied, what you've invested, what you've done. And if you said, where's he at now? And see, here's the best part. The guy was a strong producer. 2.1 gross production is a lot of money. Oh, it took us about 6 months to figure out what he gross produced because his staff wouldn't do this. This is a tiny little thing, Dan. I don't want to make a right turn here, but almost every place where I see embezzlement. In fact, I had people ask, how many embezzlement cases did you have during the shutdown? 4 of them. Wow. Do you think people embezzle more during the shutdown? No, it never works that way. You just discover embezzlement anytime there's an economic correction. Anytime, because in a sense, it's a classic Ponzi scheme, and the music stopped. And when the music stops and people are scrambling for chairs, then all of a sudden people are realizing, oh, there's some money missing. But I will tell you this, the higher the adjustment, the easier it is for the staff to embezzle. That does not imply, I mean, when I have, both these 2 practices where they had over 50%, wasn't a hint or an ounce or a whiff of embezzlement. It's just bad. There's just a lot of plans. In fact, let me just tell you this. We have a lot of clients when they first start to work with us. We really push them to come up with this spreadsheet to lay out all their PPO plans. Oh, and let me just tell you, right now there's 2 kinds of PPO plans. There's regular PPO plans. It's just insurance companies. And then there's the umbrellas. I'm not going to list them. I don't need the legal trouble. But the umbrellas, in some cases, are worse than – so it's like whack-a-mole. You think you got out of this plan, and you think you got out of this certain insurance plan, and then 6 months later you see the patient. You're actually glad to see the patient. You're like, oh, I'm so glad you're here. They're like, well, yeah, I'm here under XYZ umbrella. You're like, and then you go to your front desk. You're like, they are? They're like, oh, yeah, didn't you know that? You're like, no, I didn't know that. and my point is when I use the terms, what we need to do to bring it down lower, in some cases you have to make the hard decision. Like, this is an easy one for me. If you're in a plan that adjusts off more than 40% of your fees on every single procedure, you need to realize that you probably lose money on every single procedure. And Danny, I'm not saying this as a joke. I actually had someone say to me once with a straight face, "But what about volume?" I said, "All volume does is makes your broker faster."
It does. At a certain point, you're buying the business, and you're just
So if you're in a plan where you lose money on every single procedure that you do, that's the words I would use. If you're in a plan where you lose money on every single procedure that you do with that plan, you just have to take a hard punch in the face and say, yeah, effective this day, we will have to get out. Now, and Danny, we're not talking about this today. I mean, we've got a whole way of taking people out of that. We have now. Hang on. When it's that bad, you just got to send a letter and move on. When it's higher, let's say it's only 20% off, then I can show you how to get out. You're going to lose about 20% of that percentage of patients. And don't forget this. I just want to say this one thing. So, if you're in a practice where people are like, "Oh my gosh, that insurance plan is 40% of our patients," I'm like, yeah, you're going to probably lose 20%. Watch this, of the 40%. So 20%.
Right. It's never as bad as people think, as dentists think it's
never as bad. So you're going to lose 8%, and I'd be the first one to say, well, it's 8%. And don't forget, what I find most doctors have the problem with is the emotional hit. If you said, what's the emotional hit? It's a guy who goes to your church or goes to your club, or his son got hit in the face with a baseball, and you came in on a Saturday and put them together, and they tell you, "Oh, now I've got to leave because you don't take my insurance." And the point is, we do take your insurance. We just don't take that insurance plan's fee schedule, nor do we take their restrictions and limitations. You really have to train your staff, but you can do all this. The only thing I would tell anybody about adjustments is this is a rough rule of thumb. It will take about 1 year per 10% of adjustments. So a doctor who comes to me and says, "I have 40% of adjustments," I'm like, yeah, it's going to take you four years to get out. Well, Ken, I went to this seminar and I decided I'm just going to send a letter. Yeah, that's catastrophic. You might not sacrifice. You might not survive that. Forgive me. You have to sacrifice a little bit. Oh, incidentally, if you decide to get out, you got to put your foot down on the gas when it comes to marketing. Like, you might not be able to get away with 4%. You might have to make it 5, 6, 7%. But it's worth it. I mean, I have practices. I have a practice in Southern Indiana, was doing $5 million a year, and over a 5-year period went from about 30% adjustments to nothing, Danny. I mean, nothing. They did it smart. A lot of coaching, a lot of scripting, a lot of work together.
Did they up their marketing budget to offset that as well?
They upped their training, they upped their marketing budget, they did everything. But here's the part you need to hear. If you get rid of 30% of a $5 million shop, that is $1.5 million. Now you're back to, you can give out raises and bonuses and commissions. Listen, I'm telling you right now, there are probably dentists who are listening to us who are panic-stricken about some of the ideas we're talking about, because they're like, I just got hit with a round of raises, and I'm wondering if I'm going to get my entire pay for the first quarter. I'm like, I get it. I understand that. I understand that totally. But what people are looking for right now is not just somebody to understand them. What people are looking for right now is solutions. And I'm telling you right now, these are solutions. So you need to know, with adjustment analysis, what's your net to gross adjustment, what we need to do to bring it down lower. Then finally comes growth analysis. And let me just tell you that one. So this was for me in 1988. I had gone to be with a client. So this is 35 years ago. And I was driving back from Cincinnati on an interstate. I like sports radio. I had turned it off. I was literally trying to think. And I was thinking to myself, what is the one characteristic that I notice with my most profitable practices? And I was going through the whole thing of, is it like they're, I literally did. I went through religions. I went through, literally, I was like, what about this religion or this religion? I even took a look at Cleveland Browns and Green Bay Packers fans, because Danny, that's a form of religion. I looked at,
I do.
I looked at different races. I looked at different genders. I literally thought about it. Like, I literally was going through everything. What about height? If you were a tall doctor as opposed to a shorter doctor, did it matter? The only thing that I found was different was those practices who were committed to growth. In other words, they had sat down and said, this practice will grow every year. And in the meantime, by coincidence, I had just I'd taken on a mentor of me, and I went to him and I said, of the most successful business people that you know, do they have anything in common? He said, oh, yeah. Their businesses all grow. And I said, because I'm from Ohio, I said, well, what in the 82 to 84 recession was a butt kicker. That's where the term Rust Belt got coined.
Wow.
And I remember saying to him, well, what about a recession? He went, yeah, they just don't participate in them. And I remember almost being not offended, but like, well, what do you do with that? And that evening I went home and was talking to my wife, and she just went, well, all I know about you is you'll figure it out. And, so I came up with two plaques that today, 35 years later, are still up in my office. The one is, at that time there was, I'm not going to say it here on the podcast, but there was a term, what happens. You saw it in bumper stickers all over in the 80s. And I thought, well, if you're going to say crap happens, you could also say success happens, like it's deliberate. And number two was, I wrote down, we choose not to participate in recessions. And anytime I've hired somebody, I'm always like, you need to hear that. And I want you to look at that, and I want you to memorize it, because as long as that happens, you'll always get raises. And my company,
just to put some. Go ahead. Sorry.
Well, my billings have gone up every year. I did a mindset change, and over 20 years ago, we came out with this concept. We call it the 7% solution, which is, do you grow by 7% annually? And I mean every single year. What a lot of people don't realize is if you do that, that means you're going to double every 10 years. So I was on the East Coast.
Compound interest.
Yep. And I was pointing out this practice. I said, well, of course you're at $8 million. And they kind of said, well, how would you know that? I said, easy. When we started working for you 30 years ago, you're doing $1 million. 10 years later, you're doing $2 million. 10 years later, see, a lot of people will go 1 million, 2 million, then they'll go, 3 million. No. Now, if you double, then it's 4 million. Then it'll be 8 million. I said, hey, if we're still working for you guys in 10 more years, I expect it to be 16 million. Most people don't understand compound growth like that. So right. Actually, we've changed our tune just in the last 2 years, which we now call it the 10% solution. So when we say, do you grow by 7% annually, that's the only way I know you get ahead of, you stay ahead of the growth curve. And then that.
The only way that you really flatten out growth, in my opinion, I was interviewed in 2008 during that recession, or that meltdown that we had. And, they asked about what I thought the growth plans were. I said, well, I don't participate, because to me, a downturn in the economy is like me, instead of walking into a room with a 15-foot ceiling, I walk into a room with a 12-foot ceiling. I'm still not close to banging my head against the ceiling. There's just so much more that I can do to grow my business that is irrespective of the economy. I'd have to be like so successful or in such a highly competitive and have done everything that's humanly possible to really limit my growth prospects. And even then, you can always get creative and you can find solutions. So I agree with you. You got to begin from growth mindset.
And I was going to say, that's the key word right there. Not merely growth, but you have to have a growth mindset. So you have to have that mindset where you're like, oh, we will grow every year. We will grow by 7% every year. And what's wild is you, to this day, you still run into team members sometimes, I'll have a staff member say to me, is there any chance you could walk me out to my car, or I can walk you out? And I'm like, yeah, sure. And when they're walking me out, then one of the things they'll say to me is, could you talk to doctor about us getting a raise this year? And my first question always is, how much did you grow last year? They're like, well, I don't know. I'm like, well, then that's mathematically and intellectually inconsistent for me to ask. Like, that's insulting for me to ask the doctor if you could get a raise, because that's just coming out of the doctor's pocket. So lots of times I have to go back in and really teach. We have to go in and, we have several consultants. We have to go in and teach our doctor's staffs that, hey, if you guys want to get raises, then the practice has to grow.
And that's a really interesting point you raised, because I think a lot of doctors are uncomfortable discussing the business side because they think it's confidential, or they don't want them to know. When I advocate, and I suspect, listening to you do too, and knowing you, that the teams, to be a true team member, they really deserve to be aware of how the business is doing, because then they feel it's a sense of agency and ownership, even if it's not ownership in fact. They sort of are owners, because as long as the business is properly structured, when the business does well, then everybody who's a part of it should prosper. And when they know that, then such taking you aside and asking for a raise just because they think the dentist is rich and has unlimited resources, those questions don't come up. They know when they're due a raise, because they can see it from how well the business is doing.
Because there are still people today, I mean a lot of them, who believe the earth made another revolution around the sun, so where's my raise?
Right, exactly. I've earned it just by virtue of tenure, or of still being here, still breathing.
Yep. And I know we're going to open it for questions, but I'll tell you this. All of my doctors during the 3 years of the shutdown, the shutdown, the anniversary of the shutdown in Ohio was last Friday, St. Patty's Day. And all of my doctors who went through that, I didn't see a lot of push for silly wage inflation if they had a really, really good constructive environment, and if they'd been keeping their staff informed as to what they make. Like, one of the things that we always talk about is there's something we share, it's called the staff compensation worksheet. So you're actually explaining to your staff, here's how much you make. So for instance, if you've got this hygienist who's making this, you're like, and she says, well, I would want to make this. You're like, well, but you are making that, because by the time we figure in your 6 paid holidays and your 3 weeks of PTO, and you might have some QTO, and you have a 401k, and you have health benefits, that is what you're making. And what I've noticed, Danny, I'm telling you right now, is what I've noticed is those practices did not have as much staff attrition. Now, you still had some silly ones, but you didn't have necessarily as much staff attrition. And this is more significant. In the last 9 months to 12 months, you've seen those people kind of come back. They're like, oh, I guess the grass is not really greener. And you're like, nope, it wasn't. And you got to be gracious, and you got to be, I tell dentists all the time, you got to be a statesman. You truly have to be a statesman. When they come back and they want their job back, if you don't have that position, you just have to, apologize and go, gosh, I'm sorry, we just don't have that position anymore. But, the other story I tell is, I have a client at the end of the shutdown sat down, and the they were talking about how was it going to be an hour and a half? Was it going to be an hour and 20 minutes? Was it going to be an hour and 10 minutes for hygiene? Now different states had different regs, but this was a state that had no regs. And it turned out that one of the hygienists brought in this article about aerosols and, how long do they have to use this? And this doctor had spent a lot of money on HVE and air purification. Like, he'd not only done air purification throughout the office, but he also installed it in his air handling system. So it was a very safe environment. But she handed this out to everybody. Everybody kind of listened. And then he just turned to him. He said, well, gosh, guys, I've always had this high trust for you. I'm going to let you decide whatever you want. You can go an hour and a half, you can go an hour and 20 minutes, you can go an hour and 10 minutes. Just decide what you want. And then one of the other hygienists said, but what about the commission? He said, no, the commission's the commission. And she said about the whole article on aerosols, I wouldn't say she flung it back, but she just handed back the other one. She said, I just want an hour. I just want to get back to making money. And they voted right on the spot to go back to their regular schedule. And I teased him and said, who knew that commissions got rid of aerosols? And, he laughed. But my point is as long as you're, the one thing I always tell people is you have to have good bonus structures in place. A rising tide has to lift all the boats. When your staff knows that you have a pure heart and you're really committed to making sure that the better you get, the better they'll do, then they will always be on your side.
Amen to that.
You said you wanted to ask me some questions, so let's go ahead and go for that.
I did. Man, that went fast. That was great. Thank you very much, Ken, for the power-packed, information-packed presentation. Everybody on your screen, if you're watching your screen, is how to reach Ken. And he's also offered an unbelievable gift just for attending and reaching out to Ken's lovely wife, Kay. All you need to do is call the number on the screen or reach out to Ken Runkle at the ParagonProgram.com, and he will spend 2 hours of his time going through your practice wants, needs, pain points. Incredible. Thank you very much for that, Ken. And with that, let's jump into some questions here in the time remaining. We got a lot of them. Got a very engaged audience today. Question 1. I need more clarity in my overhead. What steps should I take to get it under control? That could take another couple of hours, but why don't you try to tackle that?
First one is to lay your. I'm assuming, Danny, that they have access to these slides. Is that accurate or inaccurate?
We will shortly be sending a link to the recording of this, and we can also we can send the slide deck to them as well.
Yeah. So you take that, you take an example of that P&L, and you go to your accountant and say, I'd like my P&Ls to look like this. When your accountant says, I can't make it happen like that, then give Danny or myself a call. I'll send you to an accountant who can lay it out like that. My observation has been most of the time accountants are like, okay, well, now hang on. You're not going to be able to reach an accountant between now and April 16th, for heaven's sakes, and ask them to change your P&Ls. Right. That would be offensive and unrealistic. What I am saying is, in the next 6 months, if you want more clarity, you just say to them, I'd like my P&Ls. And you want to start to get a handle on your data points. So that's probably the first one. That's probably the first one and the biggest one. Second one is you want to start to review that with your accountant and start to look at those percentages. Incidentally, some P&Ls actually put the recommended percentages in the P&L, so you can start to see where that is. And then you, doctor, you'll have to take some leadership in the overhead control. You can't just delegate this to your bookkeeper, your office manager, or a spouse. You will have to get interested in it. And
a good point. A lot of doctors don't really like to get into the numeric weeds. I understand that, but I agree with you. They need to. And I've been sort of disappointed to learn. I don't know if this has been your experience, Ken, but I talk to a number of my health partners, even though it's not our area, but we do get into discussions about practice management and overhead control. And I will often ask them, well, have you discussed this with your accountant? And they say no. I haven't, because I don't think they'll do that for me. And I think a lot of it is that they haven't asked the question. But in your experience, most CPAs are willing to kind of roll up their sleeves and work with a practice on more than just tax filing and actually working on overhead.
I would say the majority of them do, yes. But every once in a while, you have that one or other accountant who says, not willing to do that. I know that because I get phone calls of people who say, my accountant says they're not willing to do that. And I always, I think you know my style, I always give them 3 names. I'm like, here, you can talk to this one, or this one. And my point is one of those 3 will, all 3 of those will work with you, and you'll know which is the best one for you. So if you've got an accountant who says he won't do it, then you need to work with somebody who to me, it's like you're spending a lot of money on this, and the least you should have it done is have it done so that you understand it. So
yeah, but I mean, a lot of these relationships, just not to belabor the point, the accountant is being paid for tax filing, for tax prep, and they'll charge an hourly for additional work. And I agree with you. Most of them are able and ought to be willing to do it. You may need to pay them a little extra because they're not on retainer. They are on retainer, but there's a certain scope that may have been assumed when you negotiated the agreement with them in the first place, right?
Right. Yes.
Yeah.
Yes.
So you got to be reasonable, but yeah, if you're going to ask them to do more work, then expect to pay more. But it should be money well spent.
It is money well spent, because now for the first time you're starting to get a handle of what your true overhead is.
Right. Okay. Did you want to elaborate on that? I kind of interrupted you.
Nope. I'm agreeing with you.
Okay, we're good. All right, great. In the model of profitability, I see some percentages that are different in my office. Is there some leeway in this area? You sort of touched on that probably after this question was posed, but if you'd like to elaborate now.
No, you tend to see, for instance, the one I said I see the most is payroll. You'll see a payroll where it's 27%. And that growth will handle that. Every once in a while, I look at a payroll where the payroll is like 40%. I'm like, well, that practice is either, spending too much on payroll or they're underproductive. And I will say this one thing. You can't go to the office staff and ask them if they need help. If you had 2 people on the front, they need 4. If you ask 4 people, they need 6. I'm just telling you, that's the way of that market. Your staff will always think they're working, need 1 or 2 more people. Sometimes you'll look at a practice, I'm like, well, a little bit of the reason you have so much payroll is you don't have the technological implementation you should have.
They're not being efficient.
Yeah, I mean, there's phenomenal companies out there that are doing Danny, that right there in Chicago is terrific, really good company that does insurance verification. Like, why somebody wouldn't want to use them, I don't know. There's also Zoob. I probably lean towards Verific because I just think they do a great job. But there are other companies that do that. You still have doctors who are like, well, we've got Sally who spends half a day doing insurance verification. I'm like, no, I mean, today you just punch a button, walk away, do your morning huddle. When you come back, 97% of your insurance is verified. Mm-hmm. So some of this stuff is technology implementation.
Yep, and outsourcing, not being afraid to do a little bit of that too.
Right.
Where would you place your vehicle? I guess my vehicle in the percentages.
I wouldn't. I'd put it in profitability.
Okay.
It's not a necessary and ordinary reasonable expense.
Yeah, it's discretionary.
Right. Nobody needs a Ford Escape, and nobody needs a Ferrari. You don't need a car to run a dental practice.
Yep. My marketing isn't at 4. Go ahead, Ken. Sorry.
Well, when I see guys will start to argue with me about that. They're like, well, my accountant says you can put it in there. I'm like, no, you're not understanding. I'm not making myself clear. It's my fault for not making it clear. What I'm saying is you can have a tricked out Mercedes-Benz, but you need to call that profitability. It's not part of your 50% overhead. Right. Now, we're going to call it overhead, so it's deductible. I get that. I'm not stupid.
Right.
But that's on your tax P&L, not your practice management P&L.
Right. I mean, legitimately, unless you're making house calls, you don't need a car to run a practice. I mean, your business and my business are different, Ken. We do need a vehicle.
Right.
Yep. My marketing isn't at 4%. Do you see some differences in percentages in the different practices you work with? And I would add, are there different, and you mentioned one scenario where you're getting off a PPO, or like a startup, for instance. Would you agree that there are times and places to invest more in marketing? Well,
if you're a startup, you got to run 10%. And 10%, and then 10% is really like where you want to be at the end of 3 years. So you're investing a lot of money in a startup. If you said you are, oh yeah, my heavens, one of the worst decisions that I see a lot of doctors make is that they say, I don't have the money to invest in marketing, so I'll just join PPO plans because then they can bring this. I was in a practice recently, 3 women in this practice. These are real numbers. Going to gross $4 million, adjust off $1 million, and then they will net produce $3 million and collect every penny of it. And if you went, wow, that's a lot. I'm like, yeah, Danny, when's the last time you saw a $1 million marketing budget on a $4 million practice? Never. So my point is, that's a practice where they have to make some hard. The problem is they've been in this process too long. Now it's going to take them. You said how much? Well, it's 25%. So minimum of 2.5. And I told them, if I were you, I'd figure 3 to 4 years to get out. When they get out, and they'll go from that 4. My point is, if you said, would you take it all the way down? I'd probably take it down to 10%. So 10% off $4 million is $400,000. So I'd be getting out of $600,000 in the next 2 or 3 years. You said you would? Yep. And it's still a good deal for them.
Mm-hmm. I'm still astounded. And the last, for whatever reason, the last 6 months, I've been introduced to several startups. And, you know, it's several months because they were referred to me by leasing companies and you know, groups that were responsible for the build out, et cetera. And, but nobody even has a budget for marketing. In the last 6 that I've been introduced to, they didn't bother to factor that in when they took out their working capital loan for marketing. And they just somehow feel that if you build it, they will come. And, you know, that's nice if it's true. And sometimes you can place yourself in a real plum location. But, and you know, 10 percentages don't count because that would be 10% of zero for them.
Right. With your permission, almost 200 years ago, I think it was 1840, Ralph Waldo Emerson said, you know, his one comment on business was, build a better mousetrap and the world will beat a path to your door.
To your door.
I would change that today. Build a better mousetrap and forget the market, and you will end up with a warehouse full of mousetraps.
I like that.
So it's that simple. If you're a startup practice and you refuse to market, you're going to get your head handed to you. And in fact,
many of them do, and it's sad because it's like a train wreck in slow motion that we're watching. It is sad.
And what you're going to, or what you'll see them do is, within a year or 2, they are so panic stricken, they will go out and sign up for every plan they can, and within 2 years, they're doing $1.5 million. They're really proud of themselves. I'm up to $1.5 million gross, and I'm going to just off $600,000. I'll net produce $900,000 and collect every penny. And I'm like, yeah, $600,000. And when you say $600,000 for marketing, that's insane. And when you say to me, you know, the leasing companies refer you, of course they do. They don't want to lose their money. And they're realizing if this guy doesn't have a marketing budget, it also means he doesn't have a marketing company. If he doesn't have a marketing company, then they really haven't constructed things in such a way that they would be able to do this. So
that's right.
Yeah.
Well, that's what we continue to see. I thought it would be different. I've been at this just about as long as you. We'll celebrate 35 years in July. And of course, when we started, you couldn't use the M word in polite company. Marketing was considered evil, but you know it's not anymore. But there's still a lot of education that needs to take place, and so I appreciate that you're a big part of sharing that important message. So should the percentage? Oh yeah, you know what? We answered this one about whether there were times when investing in a different percentage of marketing was indicated. If I am not growing by 7% annually, what would you suggest as the first step to getting there?
Make sure you have a growth mindset of the doctor. Number 2 is make sure you have a growth mindset of the staff. Number 3, make sure that you've actually got actual marketing in place, because you probably don't. Incidentally, make sure, number 4, this is one of the things you, Danny, teach, is make sure you have the systems to handle that marketing. For instance, I will see doctors say to me, I need to see, I'll make up a number. I need to see 24 new patients a month to figure out how I could grow. I'm like, okay, well, let's say 32 new patients a month. I need to see 32 new patients a month. All right, well, how many days do you work per month? I average 16 days. Okay, so you have 16. If you've got 16 days a month and you're planning on 32 new patients, you should have 2 new patient slots every day in the schedule, correct? No, do you think I need that? Yeah, because see, that's inconsistent. That's mathematically inconsistent. To believe that you're going to get 32 new patients and not have 30, to spend the marketing on spend the money on marketing for 32 new patients, you don't have 32 slots. I see this happen in practices all the time. I'm back to the leadership thing. So the doctor has to go to the front desk and go, look, starting in April or May, we have to have 32 new patient slots. And when they don't do that, then what happens is you, Danny, help them create the marketing plan, a marketing budget. They start to spend the money. And when patients call in, they tell them, oh, we'd love to see you as a new patient in July. The patient's like,
right.
What? You know, like, why are you spending money on marketing? You can't see new patients for 3 months.
Yeah, it's so true. And I'll really be nervous when I talk to someone who's doing a startup and they say, I'm only going to be open 2 days a week or 3 days a week. So it's like, you know, you may be offended by it, but you're really a retail business. And retail businesses, if you don't have the inventory on the shelves, then you can attract customers, but they're not going to buy because you don't have anything to sell them. Well, your inventory is your availability. And new patients are not going to wait 3 months to come in.
Nope.
Absolutely.
So that's where you got to be if you're at the 7% solution. If you're below that.
Got it. Is there a recommendation for tracking my daily goals for hygiene and production?
The problem is I don't know where everybody. Yes, there's always a recommendation. You should track them. I won't give you numbers because I don't know where that doctor is at. If you're in Mansfield, Ohio, you're going to have a totally different number than if you're downtown Chicago, you know, right off Wacker or right off the Loop. It's two different fee schedules. It's two different. You know, we have clients in downtown Manhattan. That fee structure is so much different than Mansfield, Ohio, that it's silly to come up with a number because you just confuse people. So
what about a relative number, like between hygiene and dental? Because I've heard bandied about anywhere like 25 to 33% of your production should come from hygiene.
Yes, although if you get a dentist who's really a producer, you know, they can sometimes still outpace hygiene, and so all you're going to do is beat up the hygienists and make them feel like they're not doing a good job, when in fact that's not true. I know a woman who's in Eastern Ohio. She's just a monster producer. There's no other words to describe her. She's just a great producer. She has 3 full-time hygienists, but they can't outproduce her because she's just a monster producer. And we're not talking any kind of weirdo stuff like never met a buccal pit we couldn't try to turn into a crown. I'm not talking about any goofiness here.
Right. Legitimate needs, identifying an ability to sell people on the need.
Yep. She works hard. She works long. She works fast. And interestingly, I know 2 of her referring specialists who she refers to. And so I've gone behind her back and said, she's a good dentist. And they're like, oh, she's a real good dentist. I'm like, so doing big numbers is not costing her. And they're like, oh, no. That's not costing her in quality at all. I'm back to that whole mindset thing, because sometimes people are like, well, if you produce big, you're probably cutting corners. That's just not always true.
Yeah, I know a number of very high performing dentists, and they're not cutting corners.
Right.
If my case acceptance is down, how do you suggest I get it higher?
Well, you probably are going to have to hire somebody like Danny, who does a lot of coaching on case acceptance. There are a number of companies that teach case acceptance. They'll first of all always do an audit on how you present and what you're doing, and they're going to do some scripting and coaching and role playing, and then you're going to have to I'm back to that whole thing that I was talking about with the facility. If you're trying to do more and more and more dentistry, then you need to. I mean, I use the word yes. And Danny, the time you spoke for us, if you remember, I was teaching a whole day on case acceptance one day, and you came in. You were part of a panel here in Columbus, Ohio. But one of the things that I kept talking about is you have to have a mindset that you want good case acceptance, which is another word for sale. And a lot of dentists are squeamish about that. They don't want to say they want to say case acceptance rather than and the team is squeamish. And I'm like, look, it's just sales, and sales are not dirty. We're not selling drugs to teenagers, for heaven's sakes.
Right.
I mean, if
it's as ethical as the person using it, and it's communication with a purpose, or empowering people to make the decision that's in their interest. It's communication.
Well, and if you stop and think about it, it's the ultimate sale. They called you. You didn't call them. They called you. They came in. They said, I have a problem, and you said, I have a solution for it, and you present it to them. And so when you present it to them, then, the only thing I would say there is you need to make sure that all of your marketing, not your sales, your marketing reflects what you want. So you want to have all of that work that way. And then long term, this is the big one. The long term is you want patients to be able to, you need to streamline every process so that patients can say yes.
Yep. It's all a system. And people, if dentists would pay the same amount of attention to their practice management protocols as they do to their clinical protocols, that alone, I think, is a mindset shift that's necessary in many offices. And when they make that shift and they see that this is no more or less important or indicated to be consistent and to know what the system is, and then to be consistent in its application, that to me is the biggest door opener to growth and consistent profitability, when people accept that reality.
Yeah, absolutely.
All right, I got time for one more question. And this is my question, actually. Does it, a lot of this, your talk today was about EBITDA, and EBITDA was really introduced, I think, largely in the parlance, in the context of preparing a business for sale, or deciding what price to bid to buy a business. Do you think it makes sense to plan for sale as a valuable disciplining exercise? In other words, even if you're a new young practitioner, or your business is humming along and you have no immediate plans to sell, do you not agree that packaging it in your own mind as though you wanted to sell it can help with planning for growth and profitability?
Well, if you're a dentist who's been practicing between 5 and 10 years, and you're listening to this podcast, you are literally getting once a month an offer to be purchased by some DSO.
That's right.
And so the first thing they'll do is they'll ask you to calculate your EBITDA for this DSO. And so when we saw this about 5 years ago, we started teaching about it. We started teaching people how to calculate their EBITDA. This. What was interesting was, as soon as my clients started to figure out how to measure their EBITDA, the next thing I saw was they're like, well, I want to increase it. I went, yep. In fact, my observation was not that they wanted to sell faster. I know in a couple cases they're like, well, why would I want to sell fast? Why wouldn't I?
Right, when I can increase my EBITDA and command a better price. Yeah,
I will.
Exactly.
Because if you stop and think about the multiples in most practice purchases, the multiples are terrible. Mm-hmm. So if you said, give me, and I'll finish with this. If you said, a guy said, oh, because I know this, I have a guy who said, oh, recently I had somebody offer me 6 EBITDA. That's the multiple to buy. Okay, how long do you have to buy? How long do you have to work? 5 years. I'm like, okay, so you got 1 net. Yeah. They're like, what? But if they give you 6, you have to work for 5, you're giving up the EBITDA every year. Are you sure? Of course. That's what they purchased, was the EBITDA. They use words like they're buying the practice. They're not buying the practice. They're buying the EBITDA. Danny, the only one that I haven't seen so far, I've not seen this one. I think I'll see it in my career, is the guy who was giving 6 EBITDA, and then he had to work 7 years. In other words, wow. I'm like, what? You not only gave it away, you actually paid them to take it off your hands. Mm-hmm. I have not seen that one yet, and I'm afraid to. But hang on, I have seen 2 or 3 where it's like, we'll give you 5, we'll give you a multiple of 5, because Most people will say, I got a multiple of 5, I got a multiple of 8, I got a multiple of this or that. I'm like, what's the employment agreement? They're like, what? What's the employment agreement? If you got an offer of 5 EBITDA, and then you have to work for 5 years, you got an offer of 0.
Right.
You got net 0. And
Yep.
don't bother telling me, well, one's at capital gains, taxed at capital gains, the other one's at ordinary. It's just silly. I mean, in fact, that's what I would tell the average guy right now. The average sale dentist to dentist is 4 EBITDA. It is? Yeah. So if you had to work for 5 years, here's what you ought to do. Work the next 5 years. It's taxed at ordinary. Then sell it to your associate for 4 EBITDA. So you ended up getting 9 EBITDA. And here's the best part. You're still in charge of your life until the day you retire. Oh, and I've had people say, so Paragon is against growth. I'm like, against selling to DSOs. I'm like, no, we're not. I think it's a great idea. Just get a good big multiple.
Yeah, definitely. All right. Well, that was great. I knew it would be. Thank you very much again for a great presentation, and especially for that generous offer to talk with any of our attendees who want to learn more about how you can help them. And with that, I'll just remind everybody that in a few days you will receive an email detailing how to apply to receive for your 1 1/2 hours of PACE-approved continuing education credit. And I now want to invite you to mark your calendars for Thursday, April 20th, when my very special guest will be Mr. Gary Harker, whose presentation is titled The Use of Legal Entities for Tax Reduction and Lawsuit Protection. Keep what you earn. Dental and medical professionals have unfortunately become all too easy targets for litigation. Learning how to use legal entities to your advantage is vital to protecting everything you have worked so hard to achieve. Setting up C Corps, S Corps, and LLCs is only part of the answer. You will also learn tax strategies that will put thousands of dollars every year back into your pocket. This course will show you how to protect your most valuable asset, namely your medical or dental license. As an attendee, you will learn to protect all assets, business and personal, from any lawsuit from any direction, to remain focused on improved patient care instead of malpractice defense, to understand your present legal structure to reduce your income tax, the proper use of trusts, partnerships, LLCs, and other entities, and to apply a streamlined collection of effective protocols to help protect your license to practice. It all happens on Thursday, April 20th, so be sure to save the date and watch your inbox to register. Until then, this is Danny Bobrow thanking you for your commitment to practice perfection, and a special thanks once again to Mr. Ken Runkle.
Thanks, my friend.
Goodbye, everybody.